So I don't want to keep giving you information. Plus, I'm going to run out of things to talk about. And what am I going to do? Create some magic indicators and throw those at you like everybody else does? Can't do it. So there is some longer term stuff that we're looking at. That's going to take a while to get online, but again, it won't be weeks of information. I think for most people, they're not lacking information, but I do think there's some information we need to relay in this meeting. So I've got another webinar coming up that's going to go into specifics on ranges, and I think that's going to be on Futures.io. And in that webinar, it's not going to go over new information. It's stuff we've gone over a few times, but the perspective is basically on how to get it working for you. So there's a bunch of traders out there who believe they've tried everything and nothing works. If that's you, just type yes, nothing to be ashamed of. And I think that's the nut we have to crack, right? And I don't think it's information. I don't think it's knowledge, because most of the retail traders I know have got encyclopedic knowledge of useless crap, right? So we don't add more knowledge. It's something else, right? So it's no information. I don't think it's psychology either. I just think part of it is I think we learn in different ways, and I want to start working with traders in the group therapy with their problems, and we'll see what happens. And what will happen sometimes, a trader will come in and he's like, yeah, I'll do this group therapy thing and I'll let you use me as a guinea pig. And then we'll give them the first set of tasks and we'll never hear from them again, right? That probably will happen. And if it does, we'll just take it and learn from it. I think we learn in different ways, and I think we need to basically look at that angle about different approaches. So the approach we can talk about in the Futures.io webinar, it's not something we've talked about before, but it's just a different way to tackle that situation where you feel like you've got nothing that works. You feel like you've tried everything. And we say, okay, fresh start, do this, right? And it will be a way to become, a way to get you to the point where you can trade ranges, but also see a progression, right? And it's just a different approach. Now, I didn't really know much about learning. In my career, I did a lot of teaching, believe it or not. And, but it was always like 1 week, 2 week courses. It was never like a degree course or a 6-week course. It was like 1 week, 2 week, learn this technology. Thank you very much. And I thought teaching was a pretty straightforward thing. And I had experience that knocked the stuffing out of me in terms of really understanding that we learn in different ways. And I'm not trying to bore you with my life story, but it's kind of interesting. So when my son was 4 years old, he got kicked out of school, which is quite an achievement, right? And we went to the school and this teacher sat us down and said, he's not right. There's something wrong with him. He's slow. He'll never go to university. Forget him having to trade. You'll be lucky if you can tie his shoelaces, right? I mean, it was like, and that came from nowhere, right? So they threw him out of school, private school, right? And it was harrowing. And I'm also in a developing country, for whatever that means nowadays, where there's not much care for learning disabilities. And I just didn't know what to do. So we went around. I had doctors telling me my son was autistic. Some of them wanted to put him on Ritalin. I wanted to put those doctors on the floor when they said that. And then we found this woman called Donna Murray that whenever I see this woman, I embarrass the crap out of her. Because if I'm with my son, I'm like, son, this is the woman that saved your life. Like really, this woman saved my son's life. And I gush every time I see her. It must be really embarrassing. She was an Australian psychologist and she just knew what tests to do. The Stanford BNA test to find what his issue was. Now, the problem was if you asked him what he wanted for breakfast, he'd say, Spider-Man, 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 Spider-Man. And we knew it wasn't right, but we thought he'd grow out of it. And on the other hand, if you put a Coldplay album on in the car, now Coldplay at one point, in my defense, was cool, right? He'd sing along every word. So it wasn't a memory thing. We just didn't know what it was. And it turned out he had some kind of language development issues. Now, it wasn't an issue with having 2 languages spoken at home. It was just language in general. He just didn't get it, right? So there you've got a kid who doesn't understand language. How are you going to teach him language without talking to him? So problem diagnosed, and he went to a special school called Acorns to Oak, or ATOC, run by a bunch of women from 5 miles from my hometown in England. And it was the only special school in Bangkok. 4 terms later, and about $50,000, he was fixed. I couldn't believe it. He could talk. He could. I don't know how they did it. It's like, how do you teach somebody something without speaking? And he was fixed. He went back to regular school, but they said, look, he's going to go back into regular school and he'll be fine. But at some point, he'll hit a wall. And I'm like, yeah. And I'm thinking, yeah, he's over it. And then it happened, right? It happened about 2 years later. And it's so weird, as bizarre as it sounds, if the teachers gave the kids a list of stuff to do, right, do this, and this, even if it was written down on a blackboard, he did not have the tools mentally to follow that. He couldn't follow a list of instructions. I mean, it sounds like most of my staff, actually. And I don't, so he hit a wall. He was coming behind. And then the therapist came in, worked with him, and basically gave him the tools to take the way he learns and kind of, so he can work in that environment and kind of get on with it. I don't really understand it. Now the kid's 18, plays drums, piano, he sings, he writes music, he produces his own music, he's starting his own business, right? Now, he could have been in so much trouble if I hadn't been so persistent. But there's nothing wrong with him. It's just like school's built for the way most people learn, and some people learn different. And so that experience really stuck with me for a long time. Not really to bore you with my life story, but I want to mix things up a bit and get away from anything that says you need to know more and start to focus on different people's problems, real people's issues and approaches to resolving them. Not because I'm a genius, but I do have access to people who are smarter than me as well in trading. And I'm thinking that maybe that will help people who are wired a bit different and can relate to a certain story. And that's what I want to do. I mean, we'll see how it goes. If you want to go back to teaching, we can. But do you understand why, why we're doing that? Okay, cool. So we'll go with that, and it'll be easier for me because I don't have to prep anything, right? So we're going to go into that. But there was one thing I really wanted to do before we shift into this mode. Okay, and this was this 2-part webinar. This is part 2. This is really similar to an event we did at Wealth 365, but I had to really rush through it, right? We couldn't stop to answer questions. And I wasn't happy to leave this topic at that, right? Plus, generally when I do a webinar, it's better the second time round. So this is group therapy, keep the discussion rolling. If we can stick the questions to the chat and not the Q&A, just be easier for me. Now, can you see the slides? T, I don't know what that means. I think it's a typo. Right. So I never thought about this that much until I was in an internet forum one day and somebody said this: I'm looking for an indicator that tells me whether the market has moved from trend to chop or back. And I thought it was a really interesting question, because if you could have an indicator that told you that in time to take advantage, you would have the holy grail of trading, right? And that says, so this guy, I just want an indicator that tells me he's trending or chopping. And you can do it, mathematically and programmatically you can do it, but you need the range to be established before you can say, right, I'm in a range mode. And of course, you don't want to wait for the range to be established before you start reacting to the range. And it is one of the most important common questions asked by aspiring traders. And people are looking for a box solution to make what I believe is the most important decision in trading, right? And it sounds kind of a bit, I know it sounds a bit wild to say that, but I think you'll buy this as we go forward. So, it's usually when this question gets asked, it's usually as like a minor point, like a fine tuning thing, right? I just want to know, I've got everything good. I just want to know if it's a trend or a range, something that will enhance what you do. But my opinion is this kind of is the method, right? Or this is one of the key parts of the method. This is one of the most important parts of your strategy. It's not an afterthought or fine tuning. So I want to go over it. Now, what we see is as traders progress, they usually learn the hard way that trending and range bound markets require almost opposing strategies. Now, everything's shades of gray, right? So when I talk in absolutes, right, yeah, you can argue against the absolute, but I'm kind of trying to, level it out and, not go into too much detail. You know what? You could trade a pullback in a range, right? But it's not normal, right? It's not normal because usually if it's a range, there's not enough room to trade a pullback. So, but basically the trading a range markets, basically, they require opposing strategies. So in a range, you make money basically three ways. You make money from fading the extremes. You make money from head fakes that reverse back into the range, and you make money from breakouts, right? Trades in the middle are pretty tough, right? Like a pullback. So, if you have a range, getting a pullback in the middle of the range, it's a tough trade. You don't have a lot of upside because you think it's probably going to reverse at the other side of the range. And you're probably looking at a one-to-one risk reward. It's not really an optimal trade, right? So trades in the middle are tough as well because when it gets into the middle of the range, it tends to churn a bit, right? Now in a trend, you make money either at the start of the trend, which you all know I don't like, and from trades in the middle, the pullbacks, right? So fading the extremes or the actual reversal trade is very difficult. Selling the market that's moving up is the biggest cause of trade losses as I see it. So if we look at these two market states, range and trend, they require opposing strategies. Hence the need for some kind of early warning when the state is changing. Or another way to look at it, if the market's trending up, you can pretty much get in long anywhere. As long as you've got a wide enough stop, right? If the market's trending up, you can just get in, sit in your hands and make money. If the market's in a range, you can buy the range low or somewhere near it and then sit on your hands, right? Two different things. Of course, people don't want to trade like that. They do want to have more precise entries, and rightly so, but you kind of get the point, yeah? So this isn't really just like a facet of trading. It's probably more important than the setup itself, right? So your setup might get you a better price, but it's this bias and market mode that's going to get you taking the right setups in the first place. So getting this right, in my opinion, it's 50% of the battle. It's not that hard either, to be honest, but you can get a warning much earlier than most people are looking at it. So if you look at an indicator or an oscillator, they just need too much history to identify the new state, right? You don't need that as a discretionary trader. And I'll show you how to spot the switch shortly, right? So the range on the chart on the left is typical. We know that ranges are messy, right? So one of the things, have you all got used to the fact that your charts are really ugly? Or are you still looking for, because I know there's some charts, is it the Renko chart that kind of paints an uptrend like it's really perfect? Is that the Renko? Okay, yeah. I'm not very good on chart types. I hate that, right? So your charts are generally ugly. So this could be a typical range where we overshoot the range and overshoot a little bit and a bit more of an overshoot, and then we don't make it all the way to the bottom, and then we go to the top. Yeah, I know you like them, Sudhir. I think they're awful, and I think they're awful because they just don't tell you. They tune stuff out. I like the comment. I don't know if you can see the comments from Sudhir. He's funny. So I like ugly charts, right? I think you have to get used to ugly charts. So ranges are messy. We get shortfalls where we can't make it to the other side. We get false breaks. They're limited opportunity as well. So reasonable expectation is to hit the other side of the range as your best case scenario, but they're also predictable, right? You also kind of know what's going on. It's a ping pong, right? Middle of range is messy. Like if you trade halfway through the range, you're killing your risk reward, right? I know sometimes you want to get into the trade. Sometimes it's going to the other side, but you really need to kind of not get in the middle, right? It just doesn't make sense because if you keep doing it, you increase the win rate you need to make a profit, right? It doesn't make sense. So good traders maximize their ability to be wrong and still profit, right? That's what you need to do. You need to be able to be wrong and still make plenty of money, right? Now, I know that many vendors in the industry are flooding your inbox with high win rate systems, 90%, 95%, 100%, we haven't had a losing trade in X amount, all this kind of crap. And they're selling that not because those systems work, but it's because what you want to hear, right? That you can be right 90% of the time, right? On the other hand, I mean, you guys know the traders that are doing 7-figure days because the information's out there now, right? People are making more than $1 million. Their win rate's 50%, right? They just trade scenarios where the winners will be bigger than their losers and they can have a losing streak and it doesn't matter. So within a range, it's really important to get on at the extreme, right? If you're doing a reversion. And there's two extremes. There's the head fake extreme where it extends past, looks like it's going to break and then something stops it. And then there's just the regular, getting in at each end, right? Really, really important, right? But you don't need to be right all the time. If you're getting in the middle, you do have to be right much more often, right? So getting the extremes is just part of ensuring that your winners are bigger than your losers, right? That's all it is. Impact on your P&L and your sanity cannot be overstated if you use a risk-reward based approach over a win rate based approach. Now, how many people feel uncomfortable with the idea that with a 50% win rate? How many people feel uncomfortable with that? And it's okay if you do, right? Now, yeah. So there's a few people, and if so, Anthony, Aaron, Coleman. Yeah, sorry, it wasn't Coleman. It was sorry, I was reading the names off. Judge. Do you know why that is? Why do you feel uncomfortable? Is it just because it's been drummed into you by all the ads? What is it? Because I don't know where it comes from. Because when you come into this, you come into it with no expectations, right? Any idea? Anyone want to say if they know where it comes from? Because I want to be right more than 50%. Anthony, you're obviously not married. Yeah, I mean. Yeah, well, it does. It kind of being wrong feels shitty. Yeah, I think we've been. For me, I just think we're bombarded with it, with the idea that the win rate needs to be high, and it's something that you will get over. And also, you don't have to trade ranges, right? So this isn't about you must trade ranges, but even if you don't trade them, you really need to know when they're forming, right? You can trade. It's like news. You need to know when it's going on, even if you're not trading it. Right, so you can trade them or not, but you just can't ignore them. Now, trending markets also have a specific fingerprint we can identify in real time. So we can tell when it's reverting to range, we can tell when it's in a trend, and then we can have a specific approach to trading them. So most traders start off by trying to catch the very end of the trend because, books and ads and people on forums convince them that trading is a game of selling highs and buying lows. So do we have any people in here that are trying to, watch market go down and then try and buy the low? Have we got any people who are still trying to do that here? And it's fine if you are. Okay. Yeah, it's really difficult, right? And it's like, it's funny because like you're buying a market. If you're buying a market that's moving down, and the other funny thing is, you've got this skill that you're not using. The skill that you're not using is the ability to tell that the thing's going down, that the thing's in a trend, right? So when you're watching it go down, right, and you're waiting to buy, right, you've got this built-in skill of being able to identify when the market's in a trend, right? Would you agree with that? Yeah. Okay. Yeah. So because it's going down, maybe you don't done not yet, but yeah. So it's going down, but you're waiting to buy. So a lot of people start off trying to catch the end of a trend, but it's really because they've been influenced by stuff they've read more than seeing somebody actually do it. Because I've been in this game now 15, 20 years, and I work with professional retail traders. I've honestly, in all this time, not met a trader that could consistently find top and bottom of trends of the day. I've never found that a person that's doing it. Doesn't mean it can't be done, but I haven't seen it, so it's probably rare. And so for me, forget it, right? So this finding tops and bottoms is a very difficult thing to do, but once it's in a trend, it's in a trend, you can jump on it. You can jump on the trend. You're not always going to be right, but it's just a higher probability trade. Now, this is an ugly chart, and I like ugly charts, right? So I once heard an educator. It was really fun. It was actually the turning point in my trading. There were me and a bunch of other guys that paid a guy $6,000 each. And for $6,000 each, he sold us a course, and he traded live, real money. And over the course of about 2 months, I think there were 10 of us maybe. So he made about $60,000. Over the course of the next like 6, 7, 8 weeks, we sat there and watched him lose the 60,000. And it was a great turning point for me, because I realized I didn't need somebody like that anymore. It was like, God, I need to be doing stuff. And I'd be like, no, no, no. And like, it was a turning point to me. I stopped looking for stuff. But this was the guy, he said these reversal points, that they're the smart money, right? He used to call them wholesale prices. These are the wholesale prices. Professionals pay wholesale, right? So the professionals pay wholesale prices. Everybody else that sold on the way down was a bumbling idiot, according to this guy, right? So he honestly believed that anybody that didn't get these prices at the top was an idiot. They were schmucks, right? And if you look at the tape on the crude oil or S&P, on the way down, it's just constantly putting in big trades, big trades, big trades, right? So let's just bring that up. So you can see hundreds, 146, 136. These guys are not idiots. If they're idiots, they wouldn't have the money to do 100 lot trades. So, you know, I saw that. I saw that, and it was like, it sounded so smart that professionals pay retail, pay wholesale, and that this is all done money. But then you think about it, well, who's the guy with all these 100 contracts that he's throwing at the market? So, you know, he was teaching me to buy the lows and sell the highs. So, you know, the only winners are the people that bought at the top here, right? And that's what I was being told to believe. You know, all the people that sold on the way down were schmucks, fools, patsies, and then we watched him lose our $60,000 that we've given him. That reversal mindset means you will always be trying to sell a market that's going up. Trading gets momentum, and if you don't catch a high, sit on your hands watching the market move down, waiting for your chance to buy it. So you all know my feelings about that. We've done it lots of time. Let's break this down a bit, right? One of the things we've got to remember, and we did touch on this last time, holding times. Your fellow traders are very important when you trade. So there's different people trading for different reasons, right? Now, this isn't a PhD thesis, so I'm simplifying it, right? You know, we'll focus on futures today, but, you know, stock traders, same kind of thing. So futures markets primarily exist. Well, there's two reasons you could argue futures markets exist. One reason is to allow suppliers and buyers of goods to lock in future prices, something known as hedging. Another argument could be it's just a money generating machine for the CME. But the hedging side, you know, people like Kellogg's, I presume Kellogg's buy corn futures, so they can properly forecast cornflakes costs. Airlines hedge with fuel. It's like an insurance policy, right? So that's why futures markets have an expiry or a delivery date, because it's like, I want corn on this date. Now, if you buy car insurance, generally speaking, you don't go cashing it in after 3 months because you didn't crash your car, right? So if you're Kellogg's sitting on a corn hedge, you're not going to get out of that hedge based on some whim of the market, right? So if it's hedge, it's insurance. The tendency is with insurance, you buy your insurance, you hold it, right? So if we look at hedges, would we expect hedgers to knee jerk out of the market because the market moved 5 ticks? Do we think that would happen with somebody who's hedging? Yeah, I agree. Yeah, so we can probably say that the guys who are hedging probably aren't going to react to short-term moves. We have spreaders, right? That is just pure speculation, and I love pure speculation. So these are the traders that put on multi-part positions. So they might buy April crude, sell May crude. Why would they do that? Well, you know, in fact, why would April and May crude be different prices? Well, you've got storage costs, availability of storage, interest rates. So spreaders are going to jump in to a spread trade if by their calculation, the difference between April and May has exceeded or is below what accounts for those costs, the storage and the interest rates, right? And then they're going to exit their trade when it comes back in line. Or it keeps diverging until they can no longer take the pain, right? Because spreaders still stop out, but they just don't care like about the move in any individual market, right? So as long as the two are moving together, that's what they care about. So spreaders, again, to me, they're like hedgers. They're not going to react if the market makes a 5-tick move or goes to a level, right? Now, longer term players, like fund managers and the like, they're more news reactive than price reactive, right? So we saw with Brexit that news kept hitting the market. It's on, it's off, it's on, it's off. Second referendum, on, off, all this kind of stuff. And there was some big money going into the markets and out of the markets as that news came out, right? So again, if you're Fidelity or if you're some hedge fund and you've got, you know, you've just built a 60,000 lot position on the S&P, are you going to get out because it breaks the 3-tick range? Do you think that's what they do? Yep, I don't think that's what they do. Now, I haven't met every one of them, but it makes a lot of sense that they don't, right? So what I'm trying to do is build a picture here that not everybody is going to get the market because it moves or hits a level, right? There's like, you know, if I'm buying insurance, I've bought my insurance, I'll let the thing expire and I've locked in my price, right? So, you know, I think there's a lot of like long-term players. They are news reactive, definitely, but not so much price reactive, unless obviously they hit a target. So they're in it for the long term. They're not going to react to the kind of small short-term moves that we as day traders exploit. Now, day traders, you know, we talk about outrights. Do we understand what outrights are? Outright just means a single position, not a spread. So a longer or short position, right? So day traders are trading outrights. There's a lot of day traders, right? Are we good? Are we bad? I don't know. You know, do we create price stability or do we create, I don't know, price volatility? I don't know. Now you'll notice that there's like, we think about day traders, and then even if you look at like the terminology in market profile, they've got a terminology called other time frame, right? Which is basically everybody else, which is like a big net, right? But I think it's a really good terminology, right? Because, you know, we don't say day traders and then 3-day traders or 2.5-day traders. It's like there's day traders and there's everybody else, right? And I think that's an interesting, thing to consider, because for equity and futures markets, the margin requirements are massively different when you get into holding overnight, right? So you can trade on both markets, you can trade double the size if you're in that in the day, right? Now, there's also a risk factor as well, where if you day trade, you're at the screen, right? You might be looking at Facebook, but you're at the screen. And, you know, if you go to sleep, anything can happen while you sleep, right? And so there's overnight risk. So day traders are a category that exists. In my opinion, day traders exist because of those margin rules, right? But I don't think it's the risk. I think it's the margin rules, right? And day traders are going to react to short-term moves. In fact, it's the reaction of day traders, in my opinion, that generates all the short-term moves in the market, apart from like the news-driven ones. Then we've got market makers, HFTs, right? Who everybody says, oh, the market makers are taking it to here, or the algos are doing this. Oh, it's just unbelievable that people will actually make up truths. This stuff. They act in a time and space below all of the traders, right? So HFTs are making markets. Obviously doing a lot less of it in the S&P since COVID. HFTs are making markets effectively. It's very, very low risk trading. There's not so many, there's some things that HFTs do that people find, what's the word, distasteful. They think it's cheating. And I'm not really, I'm kind of on the fence about that, but there's a lot less of those distasteful activities in the futures markets that we trade, right? But HFTs also, they're not reacting to levels, right? They're just weaving in and out at almost all prices. Now, HFTs do provide us with liquidity we need to get in and out of the markets. But they're like, I call them fair weather market makers. So a real market maker has a real responsibility to make the market and provide liquidity. HFTs can just come and go as they please, right? So, and that's one of the reasons I think the traditional market maker, in my opinion, I think the traditional market maker I don't see the benefits of there. I think it's with HFTs on board, HFTs can make a market unless they don't want to. And now there are some edges in being a market maker, rebates and stuff like that. But I'm pretty sure HFTs get some good deals. I think the traditional market maker will die and it'll be HFTs. I think the downside of that is it gives us these volatility cycles, right? Because the thing about HFTs, they sure get out of the way when they go and get stuff. I mean, there are stories, if you look up stories, there are stories of market makers losing hundreds of millions of dollars as a market crashes because they have to provide liquidity. And HFTs don't have to do that, right? So you can see how the kind of HFT could replace the market maker, right? And it's one of the reasons volatility cycles up and down. My opinion, when you get these big peaks here, that's the HFTs disappearing. That's a lack of HFT market making the markets. It's increasing the volatility. It's too risky for them, right? That's why all the the liquidity dried up in the S&P. So when we look at the volatility, we still really are at extremes of volatility even right now, and that's why we talk about markets in relative terms, right? So a stop loss now and a stop loss 2 years ago before COVID, a completely different thing. And it's a bit like the taste of an orange, right? So if you've tasted an orange, you can probably explain the taste of an orange as somebody else has tasted it. And it's the same with fast and slow markets. There is a certain amount of observation and working with a market you need to have to really come to grasp with it. So to know, for instance, is it ranging or is it not? So a range right now on the S&P is different to a range 2 years ago, right? It has to be because this volatility cycles up and down, right? So, when the VIX is at 70, you're going to get very different looking ranges from when the VIX is at more sane levels like, 12, 13, 15. I mean, it used to be when the VIX hit 24, all of the liquidity would disappear. But, those numbers like 24 or 10 or 12 or 13, they seem like kind of crazy numbers for the VIX right now with where we are. So one of the things we're going to have to do is, keep an eye on the VIX, keep an eye on the fact that the volatility cycles up and down. And mostly HFTs are doing us a favor most of the time. But when it becomes too risky, they get out of the way, VIX shoots up, and the market changes, right? So one of the things about recognizing the stuff we're going to talk about today, you have to adapt it for the volatility. You can adapt it to different markets, and doing that is just a matter of keeping your eye on the ball, right? There is no indicator that is going to give you the metric to adjust what we're doing today, right? So what we're going to look at is some simple stuff to recognize range and trend. Don't try and add stuff to it, right? Just get used to reading it yourself and don't try and lay a lot of technical stuff on top because it's really not going to help, right? In my opinion, right? So we're going to give you a framework to get on the right side of chop trend. And that's going to be regardless of where we are on this volatility cycle, right? Now, this market maker or HFT participation is a major contributor to volume and price stability. Like I say, they're trading in that market all day, all prices. When you hear things like, the algos are taking it up to 4,500, tune it out. And if you go on forums and say that yourself, just check where you got the information from. Check where that belief came from, because that to me is a faith-based belief. It's never been explained. It's never been proven. One of the difficulties with algos moving the markets is for an algo to move a market, look where we are, we're about 200 a level on the S&P. So to move the market up 10 points right now would be about 20,000 contracts. Well, I'm never at math. 2,000 contracts. You'd have to buy 2,000 contracts to move the market up 10 ticks, right? If you then sold those 2,000 contracts, it would move back down 10 ticks, right? So this idea that somebody intentionally moves the market a large amount, it's very difficult to understand how they would profit from doing that, right? Now there's always nuance and stuff like barrier options in Forex where they fire if you get to another level, but keep it simple. So, when people talk about these algos moving the markets, what they're trying to do is pin a cause to moves. It's indicative of needing to explain what's going on. Okay. And it doesn't really matter what's going on. What matters is that we can, we can make money because the markets move before algos and HFTs. And if they ever get outlawed, which I hope they don't, the markets will still move. And quite often when people say, oh, the algos are doing this, they're just looking for an explanation that isn't there. Anyway, back to our players, right? So outside of news-driven market events, it's day traders, in my opinion, that have the most impact on what will happen next, right? Your Kellogg's guy is off for lunch. He's not watching the market because he's hedged his cornflake cost. Your spreaders aren't interested in the moving one market, but we day traders are, right? If you've got like a 3-point range and it breaks, we're going to see stops, and those stops aren't hedgers. They're not spreaders, right? It's not Fidelity and their 6,000 contracts. It's you and me. It's the day traders, right? Who are forced to day trade because of the margin rules, right? You get one built the picture I'm building here. It's like, it's almost as if you could say everybody's a day trader intraday in some circumstances. So I will just say that again, outside of news-driven markets, it's day traders that have the most impact on what's going to happen next, right? So even if hedgers and spreaders are engaging every day, we can just discount them because they're not going to react to the market moving against them the way we do, right? So as day traders, we focus quite a lot on the pain points and speculation of the day traders, while also trying not to get taken out by events that bring in longer term traders, right? So a lot of what we do, we're trying to figure out when people are offside or when we've got momentum, but we also need to keep an eye on the news, right? Because you know what, if let me think, if there's a meeting in the EU about imports or embargoes or whatever, and you just keep doing your little range trades while that meeting's on, you're going to get taken out, right? So, and you get this, you get that. I'm not saying you've got to trade the news, but I'm saying you've got to make sure it's not in the picture when you're taking your day trades. Do we get that? Yes, somebody got it right. So, sorry, just taking a drink. So what we've got to do is say, right, if we're in normal circumstances, nice, healthy, bubbly market, or even a slow range market, we can do these things, right? But we have to make sure that we're not like stepping in when news is going to hit the market. And we can't always make sure the news is going to hit us, because sometimes it comes out of the blue, right? So a lot of what we do, we're looking for other day traders to get taken out. And we're also looking to piggyback longer term traders, especially on news-driven moves. So let's focus a little bit on the pain and pleasure, right? Right. So let's consider long and shorts, right? And I would say, who here is a long trader? Hey, what's he talking about? You are long, but Marcia, do you only trade long? Yeah, both, right? So what I find really funny as well when people talk about the markets, they say, "Oh, and it's great to have a preference, Frederick." I would say, Frederick says he prefers shorts, and I think there's nothing wrong with that, right? Because there are some kind of dynamics of a market going down that can be a bit faster, for instance, than a market that's climbing up, right? So I think to specialize in one is fine. But when people say the longs are trying to do that, have you ever heard of somebody say that? The longs are trying to take it to 4,200 or 4,300 by now. You heard anybody say that? Yeah, and I wonder, well, what are these longs? Because I go long 1 minute and short the next. So I don't care where it goes, right? Yeah. So, but bulls, I mean, bulls and bears, we're all bulls and bears in the process of one day, right? So I am of the opinion that there are no longs and there are no shorts. There are no people that only trade one side, except somebody who's got a preference for shorts, which is fine. And for futures traders, that's pretty much accepted, right? Because we don't have to borrow shares to short them. We can play one side of the market just as easily as the other. So we'll play the long side if we think it's going up and the short side if we think it's going down. And it is very simple. And you're probably thinking, I'm here to learn something. That wasn't really a lesson. Now, this isn't a statement of the obvious, but if you're happy to switch between longs and shorts throughout the day, it would be rational to think that everybody else will too, right? So my view is I'm happy to go long or short. I don't care. I think everybody else is the same. All the day traders are the same. So I look at the market the same way, as a place where all participants are happy to switch long, short, and long again. Now, obviously, there's some exceptions. Stock market, if you've got a 401k, anyone got a 401k? I don't know how many Americans we've got in here. Yeah, you got 401k. Can you short stocks in your 401k? No, yeah. So like, isn't that amazing? Like, think about that. In the futures markets, we could just play one side of the market just as easy as the other. The 401k, which must be a massive contributor to money going into the markets, you can only buy. You can only go long, right? Do you not think that gives a bit of a bias on the stock market? I mean, it amazes me. You can only have one opinion. You can have the opinions going up, or you can get out. Right now, obviously, you could trade for dividends and that. I get that. So yeah, every point I make, there's a little argument you could make against it. But to me, it's a very interesting factor in what's happening with the markets. As is the fact that short sellers in equities are often compared with Joe Stalin or Hitler on the evilness scale, right? I mean, it's literally just a punt, right? If you believe a stock's going down, you're just putting your money on the fact it's going to go down. How are you evil, right? I don't get why people say that it's so evil, right? Although, you know, we do see that politicians tend to wear moves up in the market as little merit badges. I think that might have a lot to do with it. But that 401k system worries me, that you can only trade in one direction. Anyway, so yeah, there's some things about the market that, yeah, they're a bit off, but day trades and futures, we don't have to worry about that thing. There's things, it might have an overall bias on the S&P 500, obviously, because stocks are getting bought and not much shorting. And what we need to do, we've looked at the fact there's hedgers and spreaders, and they don't really matter, and the long-term days are going to react, and that, you know, there's a lot of people that are forced to day trade because of the margins. And the other thing we're going to consider now is that everybody's fine to go long or short, that everybody's like us, they're just trying to capitalize on the moves, which brings us to this, which I love this. Okay, it's a bit of a brain twister, right? Trades are made because the trader believes a future outcome is likely. Okay, I think everybody's okay with that. Trades are made because the trader believes other traders will behave in a certain way. I think we're happy with that. This is where it's a bit of a brain twister, and this is what I believe. I think all moves in the markets are caused by traders trading because they think other traders will trade a certain way, right? So basically, everybody's trying to guess what everybody else is doing, and it's that guessing that moves the market, right? So when people say the algos are moving it, or the longs are doing this, or this is moving it, what I believe is moving the markets is you. You're guessing that everybody else is going to buy after, and you buy, and that makes the market go up, right? Now, you can argue against that. I'm fine if somebody's got an argument against that, but like, you understand the concept, right? Okay, now it changes trading a little bit, doesn't it? It changes trading. It changes trading. Well, yeah, manipulated markets. Certainly, there are markets that are manipulated. You can manipulate well. I mean, there was a story a few years ago about a bunch of banks manipulating currency rates. That was pretty big. But you know, generally speaking, manipulation on futures markets, like short-term manipulation, like flipping, it's generally at quieter times. So, you know, once you get to a certain amount of volume going through, it's very difficult to kind of, it's very difficult to push it around. So, you know, ideally on something like a flip, what you're doing is you're trying to nudge prices into stops and take advantage of them. And so it's a little nudge, right? Whereas people say, you know, the algos are taking it up 50 points. And yeah, and they've just got 100,000 contract position. What do they do now? Right? So I agree. Manipulation, absolutely. How does it differ? Well, stop runs, I mean, well, okay, so stop run, how does it differ? What it differs from, if you want the market to move 10 points, or if you want the market to move 3 points, right? And you're a point away from stops, you can move the market 4 ticks, but you can make 12 ticks, because the stops will give you the other 8 ticks, and the stops will let you exit the position. So that is manipulation. It is illegal, apparently. Since they banned it, it didn't stop. I don't know who checks, but it's illegal. But it definitely goes on. But yeah, moving somebody 50 points to me doesn't make sense unless there's a way to get out after you move 50 points, right? So if you can wrap your head around this, right, maybe what's making the markets move, maybe you don't need to know about algos, what the algos are doing. Maybe you don't need to do anything. It's just people like us trying to guess what everyone else is doing and making, and the move comes from that, right? And that's, you know, philosophically, mentally, it doesn't really matter. It doesn't change the game for us. It stops you looking for this kind of certainty or this, you know, this person to blame. It then comes to be about crowd dynamics, right? Excuse me, I've got a bit of a cough at the moment. I daren't go to the shop and even get some cough medicine because they'll cart me off to COVID hospital. So I'm living with it at the moment. So excuse me. But anyway, if we can agree, in the absence of news attracting long-term players, we can logically consider that it's day traders that are going to cause most of the moves. And then we can kind of focus on them and their holding times to kind of figure out where their reaction points are, right? So are we okay with that? So what I'm trying to build a picture of is saying, let's just focus on day traders if we're day trading, because everything else just levels out, right? Unless there's news bringing in these, you know, the bigger players, right? So do we get that? So if we can say, so it's all day traders reaction. Okay, making more sense, yeah. I hate to do this, so I don't want to lose people, right? Okay, now holding times is important, right? Because there are some things that people look at that when I look at them, I think you can look at that volume there, but that person's never going to be in the market anymore, right? So if we understand how long people hold on to trades, we can also refine how far back we look for information on how the market's going to react, right? So how are we going to know how long people hold on to trades? How would we discover that? Like take a rough guess. How would we research it? Where would you start? Value areas, yes, C delta value areas. But I tell you where I would start, me. Because because I'm saying the moves in the market are created by people guessing what other people are going to do. So we've got a good idea, you know, based on what we know about other traders, we have a good idea the amount of pain somebody's going to go through in a day trade on the S&P 500 if it's not a news-driven day, right? And we know it's going to go up when the market becomes more volatile. So, you know, a couple of years ago before COVID, when the S&P was thicker, 8 ticks was a reasonable stop on the S&P, right? Doesn't mean they're going to get out if it moves 8 ticks their way, right? But, you know, we've all got an idea of like, you know, and maybe you don't know exactly, but you know somebody's not going to have a 3,000 tick stop. And they're not going to have an 8 tick stop probably in this volatility. So you might not know the exact amount, but you can have a look and say, oh, that's a bit far. And we'll see why in a second. So we think about how long people hold on to trades. Then we can think about what information do we use to figure out how they're going to react? Or another way to think about this, how long do you hold on to your positions? How about the traders you know? You know, are you expecting the market to hold on to positions longer than you do yourself? And if you expect the market to do that, why? Based on what? What is this, the market, right? Now, here's a mock crude chart. It's pink. I don't know why I made it pink because it's not my favorite color. What we got here, we've got a range at the bottom and the market breaks out and we get a trend up followed by a trend down. If you look at the prices, we got 51 where we start off here and we got high 53. So if you were short from this range area, would you still be holding that short at $53? No. Okay. So when I say how long are people holding their trades, so you get what I mean. You know, no way. So you don't have to know exactly what other people's stops are, but you know, nobody's going to sit through a $2 move on crude against them unless they know something we don't, right? Now, if you were short from this area and it went up to 53 and you stayed in and it got back to 51, would you stay in because you thought now your short was going to work, or would you get out of dodge? Yeah, exactly. So, and it's not unreasonable, right? And part of the reason is you're sweating. Yeah, you're praying for a break even. It's like you're really sweating. You've done something stupid, right? And I'm not saying it's stupid. Don't call people stupid. If I do it, it's stupid, right? So I've done something stupid. I've let it go $2 offside, and now it's coming back to absolve me. To like, I can get away with it. I don't have to lose that $5,000 or whatever it is. And so I think that there's a logical part of you that says, well, if it's going down now, you should hold it because now the direction's on your side. But the reality is, you've just like your blood pressure's like 200 over 100, right? You want out of the trade. And I think that's a pretty reasonable thing to do. And, so anybody long from 53 isn't still gonna be long at 51, right? And if you wouldn't be in, you could just say, well, I don't think anybody else will, right? The hedgers and spreaders and long-term traders would, but they're not playing this game of day trading, right? But they're also not going to go do anything. If there's a hedger in at 51, he's not going to go care if he goes down to 50, right? He's paying 51 for his cornflakes, right? So those kind of longer term techniques, it kind of makes these prices, these like shorter term prices, a bit irrelevant to those players. Traditional technical analysis would say this range is important. So basically, we start at 51, we climb up here, right? We go down here. How is this range important? How is this range relevant at this point? Because if you were long from 51 and it went up to 53, would you still be long when it come back to 51? Well, you might not want to. That's a long haul, but so if you're long from 51, it went to 53, and it comes down to 51, you're still going to keep your long. That's a big pullback, right? And so most people won't. All right. So most people, if it goes from 51 to 53, they're probably going to have taken some profits scaled out on the way up. If it comes down to 50, their entry price, they might get out, but most people are not going to be in. You're going to have a minority that's still in. So in a way, right, you might flip to the short though, but generally speaking, would you consider you traded well if you got at 51, sort of go to 53 and came back to 51? Would you be happy? Yeah. You wouldn't be following your plan, would you? Right? So if you look at technical analysis and even volume profile analysis, they will tell you this area is important, right? Because it's a level. It happens to all of us, right? So, but in technical analysis, this is a level, right? And it's important because it's a level. And obviously, is that what you understand in technical analysis? Just give me some feedback, give me some love. So my take on technical analysis is they would say this 51 price, this range price here, is of significance. Yeah, call it a supply and demand area, right? And but like none of you guys would still be in the positions you've got in that range, right? So who is it that's still there to react? Well, it might be an accumulation area, but you could say, but like if you guys won't still be in there, I mean, there might be long-term traders accumulating, but they're not going to get out if it comes back to 51 because they're long-term, right? The algos, yeah. So my premise is, okay, if it comes back down to that level, I don't think anybody's there that was there before. Now there might be new people come in, right? Doesn't mean new people won't come in, but certainly I would say that at that point, the people that got in that range are out of the market, right? Whether they were long or short, right? If they're day traders. I don't have to be right about this, right? It's just my take on it, right? So to me, I can just ignore this, right, to an extent. But what we also know is people do key off levels, people do key off charts, but you're not going to get a stop run, right? So maybe we can agree that, because I know some disagreement there, maybe we can agree that people might come into the market at that point, but it's unlikely that people still there are going to react and get stopped out. Could we agree with that? Would that be acceptable? Yeah. Michelle, I like that comment. Trade with the Mentors said, people who missed the long at the bottom want to get in again. And it's like, okay, who are they? Because I certainly don't. right? And maybe you do, maybe that's the way you work. But if I see a market at 51, it goes up to 53 and then comes back down to 51, I think that's done, right? I think it's tried to go up and failed. Okay, so we've got all these things that are supposed to be relevant. And I'm like, why? Who's there? I'm so skeptical, right? My wife hates this. Right, so we can say that maybe some of these prices are irrelevant, right? Some of the places we traded earlier are irrelevant simply because of how far we moved away from them. And that's going to be different on crude to ultra bonds to S&P. And you don't need an indicator for it. You just need to kind of have a bit of common sense to kind of like, it's like almost, like doing a thumb sketch, it's just a rough estimate, right? Now, I don't need you to agree with me. I know what you've been taught. I just want you to think about how you behave yourself and how you react. And if you're relying on people doing something you don't do yourself, then to ask why, right? Now, similar scenario, right? We've got the range at 51. Market moves up 20 cents or so from the range, comes back. Do we think people are going to still be in from this range after that 20-cent move up and back? Yeah, I mean, there were mixed answers, right? But I think, yeah, there will be some. I think there'll be some day traders still in. Maybe looking for the range. It's a big one for me. I like to arrange the form and come back and hit the top of the range and go in, right? But the difference is the amount we moved away from the range, right? We moved 20 cents up versus $2 up. That's the same pattern, right? It's the same pattern. Right, so technical analysis people say, yeah, you just trade the pattern, just trade that pattern. But to me, it's a different pattern because people just don't hold moves against $2 moves against some crude generally, right? Some will, right? But generally speaking, now did I pick right with 20 cents? I should maybe it was a bit too much still. But you get what I'm saying, right? A small move, exactly the same shape on the chart, a small move away and a move back. Right, you can presume there's going to be some people there. There might be some stops. There might be a different scenario you're looking to exploit, right? Okay, so I think in that case, probably the market didn't move far enough to wash all those traders out, right? So people short from this range, yeah, they're pretty likely to buy to cover, breathing a sigh of relief, but it only moved 20 cents against them. For traders not positioned, could be an opportunity to take a long trade, right? It's got to the old range. If the market can't get into the old range, it's a good old trade to go long. It's kind of a pullback. We've broken out. Now we're testing the old range, and people are still there. Okay, so it's the same technical setup, different expectations. So I know this is a new way to consider market action, but you just consider it in terms of what you do, right? This doesn't require external knowledge of the way other people behave, right? Yeah. Okay. So MPX has got a good point. MP, can I drag the chat across and show people what you wrote? Okay. Thank you. I'm sorry, people. This is going to have your names on it, but I think it's a good point, right? And it's a good point generally about trading in general. You've got a range, and Daniel is right here saying that they were half short and half long, right? But like I don't see it like that. I see when it comes back, we're half long and half short. But I've got a different. You can't see the chat. Oh, that's bizarre. It's probably a good old Zoom. Let me just see if I can get that turned on. Oh, you can all see it anyway, right? You can all see it anyway. But can you see MPX's comment there? Okay, let me just put it in a minute. let me just put it as a comment in the chat. Okay, and I get it. This is a really good point. A really good point, because you could almost say order flow and volume analysis and this supply and demand stuff is all irrelevant because everybody is a sell. So 50% of the people are short there and 50% are long, right? Oh, yeah. Did I just post that? Oh, yeah, okay. So here's the way I see it. In this area here, yes, 50% short, 50% long. As we move up, the shorts stop out, right? The shorts that don't step out, as we move down, they buy to cover, right? So the behavior of the shorts on the way up is a lot of them are going to bail. On the way down, they're going to get it with a sigh of relief. But yeah, in that area, it was still 50% buyers and 50% sellers. But the sellers got some heat. And so they're going to react differently when we come back down there to the buyers. So it is Daniel, right? I'm sorry to give you your real name. Do you agree with that? It's a different take on half short, half long. But I believe the shorts, one of the reasons these ranges tend to hold is because the shorts don't want to add to their shorts at that point, and they're happy to get out. Yeah. So I just didn't know if it was okay to say your real name. But is that explanation okay, or would you like to counter it? I mean, you're right, John. Buying and selling is what moves the price. Absolutely right. But when you come back to here after that 20-cent move, the buyers and the sellers are going to react differently, right? And some of the sellers are washed out. Some of them breathe a sigh of relief, right? And that's what I believe. Now, it could be wrong, but I think there's room to say yes in the range. It was half short and half long. But there's also room to say afterwards, after the move away, right? The short. So it's like having the same horse in two races. It comes in last in the first race. You're not going to back it on the second, right? So I think you can still have the two things at the same time, right? So, things that will wipe the slate clean are move. So we know if we get at 50, if there's a range of 51, we move to 53. People still there at 51 are a bit nuts. Probably not a lot of them, right? But if we've only gone a little way, they're still there, right? So we know if we're looking at action, we should consider how far away we moved, right? So we're looking for stops a lot of the time. We're looking for areas where people have engaged. But we're also going to say there's a couple of things that can cancel that out. One of the things that can cancel it out, right, is movement away from where those positions are. Because you move far enough away, the day traders will get washed out. Hedges are still there, but they don't matter, right? Other thing that's going to cancel it out is news, right? So like if you've got this little range on crude, and like we saw a year or so ago, somebody threw some missiles at a Saudi oil refinery, that stops those whatever positions there, they're irrelevant, right? So news will also wash them out because like when a refinery gets bombed, it impacts the price of crude immediately. And the amount of volume that comes into the market to react to that will overpower any volume, the amount of volume in this range, right? So it's the price, the move away in price, and then anything that will bring in a significantly larger amount of volume. So if you've got like there are 5,000 contracts in this range of positions, and then some news comes in, and like all of the big oil companies are trading, futures, crude's going to move, right? They might not be trading crude themselves on the hedge, but anyway, crude will move, right? That extra volume is it's just going to make the volume in your range insignificant, right? Okay. Now, do you all get that as well? So price move away and anything that brings in more volume, right? And it's one of the reasons, like some of the overnight high and low is pretty good in S&P, but some of the other moves that you get overnight, they're not really that significant because the volume is tiny. It's got a chart pattern that you can recognize, but like that pattern was on a way less volume than you've got right now, right? So anything that brings in, a lot of volume is gonna cancel out your analysis or where positions might be or where they might be significant. I might trade 100,000 contracts overnight on S&P, but trade that in the first 10 minutes of the morning, right? You're open. So reactions of anybody holding those overnight positions is just gonna be a ripple compared to the day volume. So, I think you get that. I don't need to labor the point. And then news, depending on the severity of news, it brings in more players. Now, I've got to say one thing about the news. I honestly think the market's a bit dumb. I don't get it, right? It's one thing I don't get. News does bring in more players, but it doesn't make them sensible or smart. In fact, as we're going through Brexit, the trades at Axia were making so much money. It was on, it was off, it was on, it was off, it was on, it was off. And every time it was on or off, the market was reacting as if that news was final. And it was just like ridiculous, right? So, we got news every few days about a deal between EU and UK. Each time we got news, it would generally be indicating that a deal had become closer or it had become further away. There was no person that was, I mean, do you guys remember Brexit, right? You remember Brexit, the farce, right? And have you noticed how Brexit has gone really quiet, right? And do you know why Brexit's gone really quiet? Brexit's gone quiet because they've got something else, right? It's not Boris. The people in the news, they've got something meatier to throw at the market. So I believe that if COVID dies down, Brexit will come to the fore, or something else will come to the fore. And it is hard to trade the news, John. But what these guys do is they look at the news and they assess bullish or bearish, and they watch the way the market's reacting. And once you watch enough Brexit pieces of news and how the market reacts to a bullish or bearish news, you get to create a strategy around it, right? And there will always be news. There will always be something in the news cycle that moves the market, because they need there to be, right? They need there to be something, right? It keeps the markets going, right? I mean, look at, and if you're running our markets are really dumb, look at people buying cryptocurrencies ahead of Elon Musk going on Saturday Night Live. Right? Crazy stuff. But even the professionals that were reacting to Brexit in this way, it blew me away. Absolutely blew me away. But the good thing is, it's actually quite predictable if you watch it. You don't have to watch it, right? But you need to be aware of it. So if you're in a Brexit environment and there was an announcement coming up, you'd get out of your positions, right? So I don't think there's any rational person that ever thought any news was final, but the market seemed to react as if it was. And that went on for over a year. And a lot of money was made by people, but it was never rational to consider the latest news was final, right? And I don't know how to explain it, but it does bring in a lot of institutional volume. They're making their decisions. I don't get it, but I'm sure there's a rational explanation of why this happens. But it's going to knock your analysis of the trend or the range completely to pot. Just wipe the slate clean, right? So to trade successfully, let's go past that, right? You got to understand that speculation-driven moves made by traders that only eat when they trade, right? So one of the reasons we have always something in the news cycle is because if we don't trade, and the institutions don't trade, nobody makes any money, right? So if you think about it, like CNBC or Bloomberg TV, all of that is paid for somehow through our trading, right? It's not like it's not like the CME is paying Bloomberg, but we're being encouraged to trade. People are taking the other side of those trades. Brokerages are paying for adverts in Bloomberg, and all that cost is coming out of our trading fees. And so there needs to be something in the market. You can't ignore it, right? And it's going to wipe out any analysis you do, right? So market isn't going to be rational, and it's always going to be there. That there has to be something in the news to make us trade, right? It's just the way it is, right? It's not good. It's not bad. Resize my screen. Is it not looking right? Okay, cool. Right. So I know we're talking about chop and trend, but we got to get through all this stuff. So we need to understand that when the news comes in, it's not really short-term speculation mode anymore. So if we're looking for short-term speculators to react, news comes in, it's all over. Excuse me. Wow, it's definitely not COVID. Right? So the news is important because it brings more people in. That wipes out the impact of the day traders. So don't look too far back, right? If it isn't a big move, just piggyback it, right? People actually are there looking to get in much earlier to piggyback a news move, but big news moves take a while to move. And, what we tend to see just on regular days, the market moves up and down and up and down. It swings up and down nicely. And for day traders, they're my favorite days. When it's just basically speculation driven moves, we can look at the volume and make some real good assessments of where people are positioned. We know that if we move too far away, they're not positioned there anymore. But the news kind of skews it for us, that kind of trading. Now, it is obviously natural to look left, right? And you can't help but look left. So this is just a random week, right? And from the 8th to the 15th, I think it's February, right? We were in a range, right? And I look at that, and there's some people say price acceptance, right? Because buyers and sellers are trading at the same prices. I see that as price disagreement. I see it as two things. I see it as the people who are going short think it's going to go down. The people who are going long think it's going to go up. And so that's not agreement or value. That's like disagreement to me, because I believe most traders are trying to, exploit a move, right? Or the outright traders. So it's a trade, it's indecision, a range, it's indecision, but it's a 50-point range, right? And what you'll see is markets often get stuck in a range for a whole week. And what I look for, and this is a really good thing to look for, watch what happens on Monday. And if Monday trades within the overnight Sunday session, there's a good chance you're going to be in a range all week, right? And then you'll get to Thursday, and then you get to Friday. If it hasn't broken by Friday, just shut the PC. So what you'll see is you'll get times like this where the overall market isn't moving anywhere. And to me, that just says nobody really knows. And I'm quite happy to work on the basis that nobody really knows, and also quite happy that it's a 50-point range, right? That isn't bad, So if I can set a bias based on that, I'm quite happy to do that. So nobody knows where it's going. There really isn't a good reason to start selling hard, right? It'll happen at some point, right? But to me, if people are indecisive, I can kind of make some decisions on their indecision. I can say, right, well, you know what? If it has, got to the bottom of this range and it does start to move up, maybe I can bias long, right? If it's in the middle of this range, maybe I want to sit on my hands a little bit. But it is a 50-point range, right? So intraday is still going to matter a lot. So when I see this, and it's quite common, and like I say, you've got to look at Monday. Monday inside Sunday is a real clue that there's no direction, right? And to me, you can call it price acceptance, call it what you want. I call it indecision, right? But I do look left. I absolutely do look left to look, are we just in a place where it's not really moving? And if it is, that's the first thing I'm going to look at to decide whether I'm going to be looking at an intraday range, right? So if we're in a market that's just moving up, I just think it's a little bit less likely that any intraday range that forms is going to stick. There's a whole bunch of things you can use to identify a range. And to me, this is just one of them, a natural one. And I look in the middle, generally speaking. If we're in the middle, I'm not really that interested, right? Now, so we've got a range to play off, right? And a lot of people put volume profiles on these ranges like this. But to me, I don't think that volume profile shows you much that you don't already know, right? So a lot of this range, it looks like we've effectively got like a bigger range and then a smaller range in the middle, okay? So of course, there's more volume in the middle range, right? Because it has to go up and down through the middle, right? So that's just normal, right? But at the start of the day, how much of that volume profile is existing positions that are going to react to a short-term move? Is it 50%, 10%, 0? What are your thoughts on, like, I've got this volume profile, it goes across 10 days. How much of that is positions that are still open? Yeah, and I think there's two sides to that answer. I think there's very few day traders. I think there could be longer term traders, and there could be traders who are making positions for 3 or 4 days and accumulating a position. I don't think there's nothing wrong with that. But when I put the volume profile on that, I think, well, if I've got this philosophy where if it moves up $2 on crude, everybody's out, what use is that volume profile, right? For this kind of trading, this kind of like short-term day trading that we're doing. Okay. Yeah, okay. It might bias traders' views. So Anthony's saying, yeah, maybe very few are still in, but it might bias new traders' views. And I agree, because some people use the volume profile, but there's so many things out there that you can use. I kind of wonder what, how many using this particular volume profile, and is it enough to sway the market? But you're right, it's the self-fulfilling prophecy. But if we look at my model, right, that we talked about already, where you're out if it moves $2, it doesn't make a lot of sense that this is really helpful, right? So to me, what I like is this, right? That tells me what I need to know. This doesn't tell me anything, because I don't think it's real. I don't think it's positions, right? There might be another reason for it to work, but I don't know what it is, right? Okay. Now, the other thing is people say, low volume nodes, right? So people say that that this is a low volume mode. That's where the market will react, right? And actually, in this case, you're probably kind of unlikely to do that. And I hear about that all the time: low volume node, high volume node, but I've never really heard a good explanation of why that price will be relevant, except really what Anthony alluded to, which is that kind of self-fulfilling prophecy, right? So if news is low, markets are directionless, and you need to be out at the end of the day, and there's not many of these longer-term players, what else are you going to play off? You can play off the volume profile, but people are going to play off the price, right? The speculators, right? The short-term traders, forget Fidelity, forget the hedgers, forget the spreaders. The guys that are going to react, they've got to play off something, right? You have to use something. I mean, you agree? You can't. It's like as much as you can diss technical analysis, right? You've got to trade based off information, right? So for me, this is enough. All I need to know is that I guess, to me, I think there's enough traders that are going to be looking at this. There's going to be a subset that are looking at this as well, but I think the majority are going to be looking at highs and lows, right? Yeah, I'm saying Fidelity are not price sensitive, but some of their volume is going to be in here, right? This volume profile might be positions that are still there because they're long term, right? So all I'm saying here is, if you're short term, looking at short term news, putting the longer term players aside, for me, it doesn't mean a 60. You're saying, when I say this, do you mean a 60-minute chart? I just mean a chart that looks back. I don't think it has to be 60 minutes or 30 minutes or whatever. Just a long-term chart that shows you the swings, shows you where it's been, right? So I'm quite happy to look at that and say, you know what? I'm happy to go short, but if it gets down to 73.50, I might ease off a little bit. Right, that's all. I'm not going to use this because it doesn't fit with my philosophy, right? But what we're trying to do is just filter stuff out, right? And say, well, what are people going to use, right? So, when I look at this, every range is going to break, right? So we've got a range to play off. We do know that at some point it's going to break, right? And playing ranges, if you want to play the ranges, which you don't have to, this isn't about playing ranges necessarily. It's not rocket science. But a lot of people, like I say, people call this price acceptance. And I don't like that, because if we have a range like this, there is no bias, there is no imbalance. Buyers and sellers are trading the same prices. It's basically an equal amount of people with opposing views, right? To me, that's not acceptance or agreement. That is disagreement, right? On the other hand, if the market's moving up, buyers are piling in, and sellers are getting out of the way, to me, that's price acceptance. To me, that's agreement, right? But I've always been contrary, right? My wife doesn't like it. So as you look left, you don't need a whole bunch of time frames. A daily or an hourly or whatever can show you enough swings so you can see, okay, where has it been? Where's it been going, right? To me, that's enough. I also like market profile charts, right? Now, I don't like market profile charts because I'm a big fan of traditional market profile theory. I like market profile charts because they're really easy to read, right? You can see where it went, right? Really, really easily, right? And I really like that. So a market profile chart, long-term chart, all you're really trying to key off in that place is Is there a bigger range in play or not? Right? You definitely keen eye on Monday, because Monday within Sundays is definitely a heads up. Also Fridays, if the range isn't broken by Friday, you know, don't go start playing major breakouts. But this gives us some way to set bias, right? This is one of the ranges that we're going to use in our analysis, right? So if we're in the middle of this range and our day starts to slow down, then it just gives us a bit more indication that, yeah, okay, intraday range as well, right? You don't need a whole bunch of time frames, okay? There is this theory that you need to do multi-time frame analysis. And it's a funny theory because people say, oh, I'm waiting for the 60, the 30, the 15, the 5, and the 1 minute chart to align. If you do that, you'll almost be finished the move on the intraday, right? You're going to miss a lot of stuff. But you need to identify very quickly when a trend is initiated or when it's over, and big picture, is it trending or not? Okay. So what we're going to do, rules. Okay. Right. This is 14th of Jan. No other reason than that's when I was doing this presentation, and it's the middle of that choppy week, right? So we're right at the open, and we can see, you know, the overnight action here. We had this chop here, and then we broke down, nice sort of move, and reversal back up into the open. Now, remember, the overnight volume is kind of less significant, is a lot lower than we're going to get the open. So 9:30 New York open time, 9:30 p.m. my time, just in case you're interested. Markets just opened. That means all of a sudden we're going to get way more volume per minute than we've traded overnight. So new volume, not necessarily in the same direction. Now, this is a swing chart. You all know this. Have you seen the swing charts? Yeah, I love them. The reason I like swing charts is because they tune out so much. I really love. It's a real instant way to look at the markets. It cleans up the charts without taking away the information. Really do like them. They're not perfect, you know. Like for instance, this area here, maybe we should have had a swing up, but you know, whatever. Okay, we don't need perfect. So the way this works, if you don't know, a swing down is red, a swing up is blue. But if the swing up has got less volume than the last swing down, it's also going to be red, right? So that's why you see these red swings up. It's because they had less volume than the last swing down. So it's really good to, it's not supposed to be like an indicator, like do this, do that, but it's really good to eyeball, you know, oh, my upswings are still lower volume. And then when this trend ends, you can see, if you look at the volumes here, 17,000, or on the upswings, 5,000, 2,000, 4,000, bit of a big one there, 8,000. Then they swing up 48 ticks, 20,000, right? That's typical of a reversal, right? So a reversal, you're going to see a couple of things. First swing is going to be big, right? A lot more ticks. It's going to have a lot more volume. And you're generally going to see a decent upswing in delta. Now, does every reversal do that? No. But it just means that when I see that big swing, I can start stalking longs immediately. So I can start stalking longs as soon as I see that swing, right? Because I know there's been a lot of buying as we come into that, right? That's what I use it for, right? I don't use it like an indicator. It's red, I'm going short. It's blue, I'm going to go long, all right? So most trends or reversals start with an above average size swing. You know, you can see this downswing when we broke here, this upswing here. It's very, very obvious. And once the market's done that, you can start stalking trades in that direction with what I consider to be quite low risk, right? Now, how does a range start? Now, there's some controversy here because I call this candy floss. Now, what do you guys call this? Yeah, Anthony, I'll send a recording to I wasn't going to send a recording, but I will to the people that attended. What do you guys call that? Sucker spin. Is that a German word? Yeah, candy floss. I think fairy floss. Do some people call it, is that what cotton candy is? Okay, 100% cotton candy. Has everybody seen them make it? Yeah, okay. Now, I have a cotton candy machine at home. I bought it for my daughter from Toys R Us. It is absolutely useless. It doesn't do what that one does, or I'm doing it wrong. But basically, you put a stick in first. A stick goes in. That's it. And then the candy floss or the cotton candy builds around the stick. I didn't know a dentist invented that. It seems a bit underhand to me. But you've seen it made. So what I want you to do now is tell yourself, right, that trend ranges start like candy floss, right, or cotton candy. Starts with a stick, and then it goes round and round, gathering volume. And that's what you're going to look for when a range is born. So let that sink in. If you need like a reference help, remember a little bit of that. Right, so what we're going to see, the stick is a single price with really high volume, right? Have any of you seen this? Have any of you been looking for this? Because we talked about it before. Okay. And John, after we taught you about it, did you notice it happening? I've been using it for 5 years. I do love you, Daniel. Okay. So this is it. So when I see this, right, what we got here, 2,585 contracts, 94.75. The moment I see that at one price, my head's thinking range. The moment I see that, it's not an indicator. It's just, okay, lot of volume. And I tell you, man, this isn't like made up stuff. You can go and look at this tomorrow, right? Daniel's been using it for 5 years. Daniel, did you get that from me or did you already know it? Oh, Peter Stiedelmeyer. Cool. That's very cool. I love this stuff, you know. So Daniel's been using it for 5 years. It's amazing. It's amazing. I don't know why more people don't talk about it. All right. So we get that volume, and then what you'll do is that's step one. So basically that happens. You're going to keep your eye on this because it could break up, right? We don't know it's a range. Step one. Now, if we've got good correlated markets, like we're trading the ES, we've got the NASDAQ and the Dow, one of the things to look for as well, right? NASDAQ going one way, Dow going the other, right? So what tends to happen when the S&P is trending is they'll all go in the same direction. And then all of a sudden, you know, and when I say NASDAQ going one way, Dow going the other, I'm talking about really low time frame. I'm talking about like a 10-second chart. You know, I mean, this is, I'll show you my workspace in a minute, but I've got here a 5-second chart for the NASDAQ. You just look and see, are they moving apart? They're not going to move apart for an hour, right? Because arbitrage will bring them back, but they just start kind of doing their own thing. So I see this volume here. I see, oh, NASDAQ seems to be pointing up and the Dow is just kind of going sideways. So that's my second thing I'm going to look for, right? So we've got the stick and now I see this. So what happens is now that first price where you get the volume, that's not necessarily going to be the middle of the range. It could end up being one of the range extremes. But what happens is it's just going to keep going up, down, around that price. That price is like the magnet and it just goes up, down, and then you just start building volume. And that's where you build the range. Okay. So it's going to cross above and below that area of high volume. It might extend more one way than the other. It's not like a guarantee. And more volume builds, and then the bigger the bulge in the profile, you know, the higher probability we're in a range. So there's also like this histogram here. It needs to be bigger than the other. You know, if it's 219, it's no good, right? So it's got to be like a lot bigger, noticeably bigger, right? It's not like 3,000 per price and then 3,100. It's like 3,000 and 6,000, right? Right. So you know it does this, and S&P will do this loads and loads of times a day. So even when the market trends, it will do this. It will pause and build a short-term micro range before moving on. Could be 10, 15-minute range. And those are all good continuation trades. If you watch the volume profile or you look at the footprint, look for this, you will see it, right? So if you're in a trend and this happens for a few minutes, you can do one of the following, right? So if you're already long and you got some breathing room, sit on your hands, right? It just could be an interim range, right? Sometimes it'll go on for hours, right? You never know, but you know it's forming, right? If you haven't got a position on, take a long off the bottom of the forming range. So what I tend to do is I'll let the range build a little bit. So on the chart, you often can't see it as a range because it hasn't really shown any swings. But I want like 6 or 7 ticks on the S&P for a range before I'll think about it. But what I'm looking to do is take a long on the bottom of the range, scale some off on the opposite end of the range, because I truly believe when we get one of these ranges in a trend, I honestly believe there's a much higher probability that we will continue, right? So I will never short the top of the trend if we're in a short the top of the range if we're in a trend, right? And we can see here we are in a trend, right? We are in a trend. We've been moving up, all right? So other thing you can do, wait for the range to grow a bit more. So the market shows you if it's building a long or short-term range, right? So, you know, you have to watch these ranges form, get comfortable with them. If you do try and trade this tomorrow, you'll have a bad experience and you'll say Peter's an idiot, right? If you just as part of your daily trading, doing the stuff you're doing now, just keep an eye on this and don't react to it. Just watch it because you're at the screen anyway, and give it some time so you really understand it and then start to attack it. Because the range isn't a strategy. The range is a pattern. The strategy is how you trade it. So for me, what I want to do is I want to get in on the bottom of the range and scale some off, because then I've got perfect continuation trade. I've got some profits and I think it's more likely to carry on. Now, at this point, we're only 3 minutes into the open. So it's not like we're in a hurry with this, but there's nothing on the chart that tells the range is forming, right? If you look at that chart, do you see that same range? And that's only a 2-minute chart. Do you guys see that? Do you see that? Let me move my cursor. Can you guys see on that 2-minute chart, there's a range? Now you're all sided typing. Well, okay. So yeah, actually, Paul, I think the answer is no. I think it looks like a trend. And this is why you can't have an indicator to tell you that the market's reverted to a range, because those are 2-minute bars here. You can't tell that that's a range yet. It will be a long time before you can, right? But this volume, this candy floss will tell you, all right? So it's like an early warning system, yeah? And we've got time to let it play out because this is like 3 minutes into the open, right? This is 20 minutes later, right? Now you could say, oh, you just cherry picked it. But, you know, you can look at this yourself. So Daniel does this. So Daniel, is this typical of your experience? Yes, okay. And he's been doing it for 5 years. So like, again, this isn't really one of the things that's going to suddenly disappear, right? And if you also look at the NASDAQ and the Dow, you know, they're both the same time frame doing completely different things, right? They're just kind of meandering around, right? It's not big moves on the Dow and the NASDAQ, but they're just both meandering around. I can't explain why those two moving in different directions is a good indication of a range. But I've just seen it enough times to know that it is. Is anybody here using that as well? The Dow and the NASDAQ going out of sync? Anybody using that? Cool, cool. Brilliant, 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 brilliant. And it works, right? It works. I mean, the thing is with all this stuff, it's not perfect, but it's just layers. So you've got the candy floss, you've got the larger term range, you've got the Dow and the NASDAQ, you got the volume, you let it build, you don't have to be in a hurry, right? Because you're going to see this range before other people, okay? So we can see the range actually started around 94.75, and we've got a high of, you know, it's a kind of thing with the wind where the high is, maybe even call 96 the high and 92.50 the low, right? You can see if you look on the chart, it's a 2-minute chart, you can see each bar on the 2-minute chart has hit the high and the low in the range 7 or 8 times each on those 2-minute bars. And it all started with those two prices with exceptional volume. Now, what I do with ranges, I'm quite happy with like 3rd or 4th hit. After that, I don't take it. Right. So even if it does hit 7 or 8 times, you've got to use your own judgment and your own comfort with being able to read the market to decide which of those extremes to get in on. Like the 50th extreme on a short-term range, it's not as safe as a 3rd. Right. The 3rd, most people don't even know it's a range yet. Right. But it all started with that 1 or 2 prices with exceptional volume. Now, sometimes it's 1 price, sometimes it's 2 prices, right? So you've got to use, you have a bit of flexibility. As I'm saying, these rules here, don't turn them into hard and fast rules. It could be 2 prices that we trade. And because we're trading at the bid and alpha, we might just churn a lot of volume at both, or it might just be 1, right? So be flexible, watch it. You know, nobody really knows for certain which way it's going to break. or what's going to happen. You know, people are quite happy to let the range form and mature, get big enough to worth playing, and still trade it before the chart makes it clear, right? So you're early for one reason, right? You're watching the actual positions build in real time, right? You're watching that switch from it's going up to what's it doing now, right? You're not watching an abstract mathematically derived indicator, which seems hit and miss in real time. A lot of time, you know, maybe the transition from trend to short-term range is just profit taking. Could be as simple as that. You don't really need to have a reason for it. Just maybe there's profit taking, a bit more balance between buying and selling, and then other people say, "Oh, it stopped here. I'm gonna offload a little bit." So we might have some profit taking, and that might trigger some more profit taking. Nothing really more complicated or technical than that. Then this kind of balance area has people thinking, "No, is the trend over?" And then all of a sudden, you know, that kind of clarity we had with the range, it's gone. You know, we've lost it. And you know what? People don't know what to do. I think it's, you know, as simple as that. And whether it's just a pause in the trend or a larger range developing, it's just not going to be immediately clear, right? So your early plays, in my opinion, should be in the direction of the previous move. If there wasn't a previous move, if it just goes into a trend, just take both sides. The bigger the range gets, the less likely is just that kind of 5-10 minute pause in a trend, which is typical for S&P. Other markets, it might be a shorter period of time. Other markets, it might be longer. Now, who do you think taught me all of this? Can you guess? Yes, absolutely. Nobody taught me this, right? And that is not me showing off, right? I'm not that smart, right? I've got some skills in some areas. I'm a good communicator. I can break stuff down, but I'm not a genius, right? Talking about my wife keeps me out of so much trouble, right? I can't wear a wristwatch because I walk into walls. How many people do you know that walk into walls? Yeah, me. Yeah. So because I'm always absorbed in something else. My brain is never where I am. I've always got a million things going on in my head, right? I mean, I can be driving to a restaurant and I'm still trying to solve coding errors in my head, right? So, and I'm just like a bit clumsy, you know, and my wife and me are a really good match because she's got a whole bunch of skills that I don't have. I'm always telling her, you know, don't scratch the car, don't do this, don't do that. Who do you think scratches the cars the most? Who backed the car into a wall 2 weeks ago? Me. Yeah, me. You know, so I'm always ragging on my wife. Oh, you're going to scratch the alloys. Then I go around the corner, crunch. So I'm not smart, right? And I don't think you need to be, but I just like to observe, and I take the time to observe. And that's one of the big things that a lot of people miss. They're so keen to trade, they don't observe. You know, you get into a trade, you get into attached to a direction, you don't observe, right? Now, why didn't somebody else teach you this? Well, my theory is that a lot of the people are just regurgitating the same stuff about indicators and oscillators and not sitting down and thinking of the market as the sum of a horde of traders with, you know, a finite time in a position and with motivations and fears similar to your own, right? So this was just observation. And the bottom line is, you know, I've been trading for years. I mean, I don't trade so much now because we've got so much going on. I'm trying to get back into it. Did a couple of days last week. But I learned it by observation just because I was there, and like, you know, you can't really miss it over time. And I was lucky enough to be kind of focused on one thing. You know, my screen set layout hasn't changed for 5 years. So with what you've been told so far, you're going to be able to observe this and see for yourself. But like what you've got to try and do is get your confidence in this, that this actually happens before you start putting positions on, right? Because your positions won't work to start with because you don't know it well enough, right? I don't want to dwell on that too much, but like that's like the difference in me. I was just sitting there, not in trades, watching it. You're now learning something new and you want to get and implement it. And I didn't implement it when I was watching it. I'm like, well, that's strange. Oh, it's happened again. Oh, it happened again. And it was just, that was it. That's what happened with me. And I know people with really low confidence that have seen things in the market that I've never seen. And their confidence is so low. They say, I was looking for this, but I saw that. Do you think I can trade it? And I'm like, are you nuts? Why are you asking me? You saw the pattern. So, this is really good stuff, right? I learned by observation. You have to observe, right? Please don't change the way you trade, right? But do look at a video, fast forward it through it later, do some replay, and keep trading the way you're trading until you've got used to this on your markets, right? Because if you don't, you're like, oh, Pete's an asshole. He taught me that yesterday, and I didn't make $1 million today, right? And that's one of the things that we're going to tackle in the next webinar on Futures.io. So before we skip to recap, I know it's a long webinar. We'll look at breaks because ranges have the head fakes, the breaks, So the opportunities in a range are quite good. And I'm actually thinking now, if I could go back and start trading again, well, I'd probably shoot myself. And you can't go back with the knowledge you've got because you wouldn't be going back, right? But if I wanted to go back now, what would I do first? If somebody could just sit me down and say, focus on ranges, I'd probably saved a lot of heartache. So with the ranges, you've got the bread and butter range trade, like fading extremes. The fake breaks, the head fakes, that's going to come in later in the range, like 7 or 8 hits of the extreme. It's also a little bit tougher to trade. And so if you are going to look at ranges, watch out for the head fakes, but just don't try and trade them yet. Don't trade one because you've seen one. Trade one because you've seen 100, right? And then there's a breakout. Now, in this case here, we've got a 6-hour range. Boredom time, right? These are really tough ones to trade because you just zone out, right? It's really hard to stay engaged. It's a bigger range and very typical of ranges that are not pausing a trend, right? So this is not a pause in an uptrend, right? We can see that, right? But the thing about ranges is the way I see ranges is like a coiled spring. It's like building energy for the break. Yeah, we got some hedges there. We got some long-term guys, but the day traders are going to get stopped out one way or the other. Some of them are, right? So the key to safely playing a break is to have the correlated markets leaning on your side, right? And this is really important because that's your safety net, right? I can't stress this hard enough, right? If you're going to play breakouts, there is a safety net. There is a lean in the market that you can rely on, but you got to have two things. You got to have the safety net, and you can't be like the deer in the headlights. It's one of those trades where you can actually get into the market, sit and watch it trade at one price, and then scratch out if the correlation markets don't go the other way. So breakdown on the S&P needs to have the Dow and the NASDAQ trading primarily on the sell side, right? Ideally, you'd also have larger traders on the sell side as we've got over here. You don't need it. But it's like if you see big traders on the sell side of the S&P, you see the NASDAQ and the Dow on the downside, it's like a good scenario. People are selling, right? And if people are selling, what's the chance it's just going to whip back against you? It's slightly lower, right? I'm not saying it can't whip back against you, but if everybody's selling, there's just a lower chance it's going to whip back against you. So you can get in here. You can get in at a low, right? The lower the range, right? Like selling the extreme of the range, right? Selling the lower of the range. Sounds kind of scary. So you have large trades on the sell side, which you have acceleration or pace of moves. If you're not using the momentum tails, it is really useful for this kind of thing. So the tail here is longer. You see the blue and the red background behind the move. That gives you an instant visual image of how fast it's moved down. So we can see that's a quick move down. So basically everything's leaning on the downside. And if you short this, you can get in a market, have all those things on your side. If one or two of them ease off, like the NQ moves up or a lot of big buyers coming on the ES, get out. That's it. What you're doing is it's leaning one way. If it stops leaning that way, you bail. That's it. No deer in the headlights. It might work. You bail. So it's a trade where you're looking to scratch the moment you see weakness in that selling. If the break does happen, range traders are going to get stopped out and you'll get that nice break, right? But the key to this is you're going to play breaks. You're going to be able to have 3 or 4 shots at a break, because the other thing about the break, if the market doesn't break down, right, and you're at the bottom of a range and the market doesn't break down, it's going to go back into the range. And that's going to be slow, right? So if you go down, you're going to trade into stops. That'll hit a stop run. But you can see this move was really fast. If you revert back into the range, it's going to be slower, right? So if it's one of those trades, it's not really risk reward. I'm not sure what the word is for it, but the downside or the losing trade is going to move more slowly than the winning trade. We need to come up with a word for that. It's not risk reward, but it's an interesting aspect of ranges. So you sit on the bottom of the range. If a couple of the things that you're looking at, like, the NASDAQ starts to go up, we see a bunch of big buyers, you just scratch it. Scratch it. Don't wait for it to hit your stop loss. That scratching it is what lets you have many attempts, because you're going to have like a few tick stop loss, and you're going to have like a 20 tick win. Oh God, Pete's saying a 2 to 20 risk reward. I shouldn't say things like that, but you can see, you've got that stop run. So it's the speed and it's the lean, right? You'll get that time expectancy ratio. Oh, that's so scientific, Daniel. Right, so time risk, time expectancy ratio. Right. So you understand. So do you understand the premise of a breakout? Everything's leaning one way. It is safe to sit in a short trade. When things stop leaning that way, you get out. Right. That's the rule. Now, to trade it effectively, you have to just watch it. You have to keep watching it. Right. Just watch these ranges, and have a tickle on sim. But you've got to you could have a 30% win rate on the breakouts and do really well. Right? It's not about being right. It's like, right, I see the lean, I see the aggression. I'm gonna get in short. I'm in short. I'm in short. It's still at my price. Still at my price. Still at my price. NQ's going up. I'm out. Right? It's a nice way to trade. I think it's a good trade, and also with that safety net behind you of it's going to be a sluggish move back up into the range. It's not going to move back into the range as fast as this move. Right? So that's range trades. So nice horizontal move down. Like I say, you don't have to be right all the time, right? That's a great thing. You don't have to be right all the time with that. All about risk reward and this time factor. And as long as all your ducks line up, you stick with it. The moment they don't, you just bail, right? Break even or a few ticks lost. Maybe a small profit. It might go your way a few ticks, and then NQ moves up, and you still get out, right? So I wouldn't have that expectation every time. But if you like the deer in the headlights, you're going to get run over, right? And we don't like getting run over, right? So we don't need to sell you anything. We don't need to use salvage. Right. So to recap, to trade effectively, you need to understand that there is a subsection of the trading community that are kind of corralled into day trading because of the margin rules, right? And understand how long they're likely to hold on to a move that goes their way or against them. To figure out, are they there, right? There's no point trading into stops that don't exist. Right? Once those positions are washed out because of news, because of a move, it's just irrelevant. and like, I know people don't like that and don't believe it. Well, it might be relevant because it's fine to disagree with me, right? Just for me, I'm very black and white. It's irrelevant. Don't want it. Don't touch it. Not looking at it. Right? So then there's the transitions that occur, right? So the transitions that kind of wipe out those positions is when considerable volume comes in. So if we traded 100 a price and we're now trading 10,000 a price, those hundreds can stop out all they like. It's not going to have an impact, right? Even if they're still there. The news is going to generate moves also, bringing that volume in. It's also going to create moves you can join. It's a bit scarier. It's very difficult sometimes to get a good price on a really rapid news-driven move. It can be very volatile. You have to throw away some of the stuff you do. You don't have to do it. But most of the time what we're doing, it's a bit more like playing chess. It's a bit more just dealing with the ebb and flow of speculators. That's what I believe it to be, right? And everything I've seen convinces me. No, I'm right. I tell that to my wife a lot and she disagrees. So regulations, margin rules, regulations, right? It's so much cheaper, or you need a much smaller pot of money to trade futures than stocks. And I think that's insane. I think it's insane that you have to have $25,000 to day trade stocks, because at $25,000, you could to day trade stocks to get like as a preparation for trading futures, you could trade 10 shares on the SPY ETF to get used to trading the S&P. But the regulations say, no, you got to have 25,000. You can open a futures trading account with like $10 and like a couple of yogurt pots, right? But you're now going to be trading 12.50 a tick, and now I know they've got the micros, but those regulations really nudge people out of positions. I'm down 50, I'm down 100, I'm down 300, I'm down 500 in a blink, right? For somebody who's got a full-time job, it's got to be a damn good full-time job to be able to afford to do it every night. So regulations are going to make people like twitchy, on the retail side. Margin rules going to mean they're in and out in the day. And even for like the prop firms, right? Because they want to use their margin. They want to go in full margin, right? So that, they are also kind of forced to, they can make more money intraday by using the margin and trading twice the size, right? So they're kind of forced to day trade. Look at FX, man. They pay an interest on holding positions overnight. There's all these different things that force people to trade the day time frame. So I think if you look at people trading for a duration of 2 days, it's a much lower number than 1 day, right? Not comparable, right? So next time you're looking at a 2-day volume profile, have a think about that, right? So that covers range and trend, or trend and chop. Any thoughts, questions? Yeah, so Dan's saying, can we have the recording? Yeah, I'm going to add this to the advanced course, but everybody who attended will get a super secret link, which you'll then share with the whole internet. I'll leave up for I'll probably do. I'll send it out to everybody for a few weeks. If somebody downloads the recording, keeps it on their PC, doesn't share it online, I am not going to mind. Okay, so I'll do it so that you can download it. And I'm just looking to the questions. Somebody's asking for the swing chart settings. It's funny when people ask me what the settings I use for particular things on the product that I own. The settings that are default are the ones I use. That's called a perk, right? So there's no there's no secret settings. Beta chart shouldn't be slow right now. It should be fairly fast. If you've got Windows 7, that could be it. Anyone want to disagree with anything we said today? Which is fine, by the way. God, my throat. Stop orders for a breakout above or below. Okay, if you've got well, there's one interesting scenario. There's no reason you couldn't put stop orders at the opposite extremes of a range. So you get like a 6-tick range, you put a stop order each side to get swept in on a break, right? There's no reason you couldn't do that, but you need more, right? You need a bit more than that. So here's a different scenario, right? Here's a different scenario. Let's say you've got like an 8-tick range on the S&P, and the market's in the 8-tick range, and the employment numbers are coming out in a minute. To me, that's a scenario where you bracket the range. So you get in whichever way it breaks. Because basically, you're probably going to get the volatility to push you outside the range, right? So I think can you bracket a range to take, to take whatever side break? It's a bit of a rough instrument, but I think in certain situations where you're expecting volatility, like the open, for instance, yeah, I can see that. But I wouldn't just do it for every range, right? That's like, it's one of those things. It would be great if it was true, right? Do I use market orders? I use both. If I want to get into, a position, I'm usually looking at the snapshot to see if people are pulling out of the way before I can go long. And it's just situational where I'll put in a bid. There are some times where there'll be trades like where we've broken out of a range and then it's going back to the range. I will put a limit in to get swept into a trade, but I've got my finger on the cancel button. But I want my limit in. I want to be there in the queue, because a lot of times when those trades where you come back to the top of the old range, it's a real bugger getting a fill. It's like you put the order in, it'll come down, you won't get filled because there's too many other people there. So for me, it's situational. Almost always my exits are limits, right? Except for the stop orders. Obviously, my profit takings are all limits, but I'm not the kind of trader that needs a 1-tick edge, and so would rather pass on a trade than give up the 1-tick loss, right? Because I'm looking for slightly bigger moves than where that wouldn't it wouldn't be relevant. So I'm kind of like, it looks good, it looks good, it looks good. I've waited a bit too long to get confirmation. There's no chance I'm going to get in a limit. I'll give up a tick, but I gave up a tick for confirmation, right? So I think there are some mathematical arguments where limit orders are better, but I think it applies to when you're kind of at an extreme of, God, I don't know the word to use. Let's say you're kind of near the edge in terms of your risk reward and your profit percentage, where you've really got like where every tick matters. Right, I think it's important then. But for me, I'm not sure. I'm not sure. Oh yeah, it is. And then I can't get in a limit, and I'm happy with that. Right. But I'm still not going to let a market move 10 ticks to get confirmation. There's still a limit, and that's where I think some of the discipline comes in. That you've seen the trade, it's a good trade, it's already going your way, but it's kind of breaking your rules to get in at that higher price. I think that's, you really have to be disciplined on that because you can't see it, but it's affecting your ability to weather a drawdown, right? On a range trade, how many ticks above or below would I put the stop? Well, again, it would depend on volatility. I'll put an emergency stop mostly. So there's a lot of trades I put on, I don't use a stop order. It's kind of a bit naughty because I'm on the other side of the world, but I would put an emergency stop below a range, but I wouldn't let it get hit. And I might put the stop just like 4 ticks below the range because it's just there, right? So if I'm at the top of the range, I'm happy to have a stop 4 ticks below the range, right? As it comes down, I might move that out a bit, right? But I just want it there. I just want something there. But it's not like that's my stop, that's where it must be. I can't move it, sacrosanct. Right? Let's watch it play out. But if I'm at the top of the range and it goes down and hits, it goes and hits my stop immediately in an instant, I'm like, okay, that's fine. That's fine. But so I've got that bit backwards. So yeah, from the top of the range, it goes up to my stop in a sudden move. Okay, it swept me out. But I tend to kind of look at just where I am in the position and kind of if we run out of steam. Like for instance, if we're in a trade from an extreme, if we can't get through the middle of the range or the point of control in the range, I'll generally bail. So I'm quite dynamic in the way I deal with the stops. But if you're going to have hard stops, 4 ticks is a bit tight for this market on the S&P. But again, you've got to weigh off against the size of the range, right? And your entry price. So if you got like 3 ticks below the range, and then you've got to add another 4 ticks on for your stop, so 7-tick stop, you need a decent sized range to make that worthwhile, right? If it's a 7-tick range, you've got to be right a lot of the time, and that's one of the things you have to do with range. It's a bit of whether you can take the trade or not. It's just a math problem more than being right or wrong, right? Is like, will this work out? And will this work out at a 50% win rate? If I take this trade and every trade was like this and I won 50% of the time, would it work out? And if the answer to that is no, I just say it's not my trade, right? If you're new to Jigsaw, the charts are, can you see my the Jigsaw screen? I know you couldn't see the chat. Yeah, okay. You just click here to get the charts. Okay. Now, there is some, we don't have charts for NT8 bridge yet. I think that's coming because we've got a lot of complaints, but you just click that, the chart button. And also very nice to see that all of the other trading platforms are now using the colors that we put together for our charts, which is interesting. Someone's asking thoughts on using ATR to determine trailing profit and stop loss. I think there's a lot of this stuff. You have to test it out. It's whether you use ATR to determine a trailing profit is purely depends on your strategy and how it performs and whether that would make it better or not, right? So it's like if you're getting in really good trades that never pull back, you can use a 1-tick stop loss, right? But my trades aren't like that. So you decide that through observation. If you're too tight with your trailing profit, obviously you're going to get taken out a lot. But some of this stuff, and I really wish I had a good mathematician. Some of this stuff is quite mathematical, like scaling, for instance, scaling approaches. You could probably find an approach to scaling into positions, right, as they go your way, that works, right? And you could find an approach for your trading profit that works. But somebody with a PhD in maths could probably determine a much better one than you've got, right? You'll understand that. Same for scaling, right? Scaling into trades. I can scale into trades, but I'm pretty sure the way I do it is not optimal. But I also don't have the skills to do it. So with things like trading profit, stop loss, you have to test it out. It has to be based on how your trades perform, right? Any thoughts having an option, add in Jigsaw to use a function key plus mouse click to trade on the dome? Instead of just, we could do that. What you'd have to do for stuff like that, Simon, send me an explanation and then we can do it. We have got some really good things coming up. I'll probably just take time to explain a couple of things. I don't know, do you know that we've now got an organization in Lahore? Okay, so what happened is we used a lot of Indian guys, right? And I used this one company that was doing journalistic, and there's this Indian guy, and he was really sharp, and he was doing journalistic, and then he quit. And when he quit, I said, well, you got to replace him. And then like the week before he left, they said, oh, there's this new guy, Amar. I know, well, he's not going to know the system, right? And then this Amar guy, he came on. I couldn't believe it. He'd only had a week of training and he knew this product inside out. Of course, what I didn't know is Amar was doing the work anyway. For some reason, there was a front man that was pretending to do the work, which it does explain, because I remember one time calling them up and saying, you know, I can't remember what the guy's name was now, but I said, can I speak to this guy? And he said, this is him. And I said, no, it's not. He said, yeah, this is him. I said, look, you've got a different voice and accent. Well, you know, I'm not so dumb, I don't know. And I said, look, if you do this again, I'm cancelling the contract. So anyway, Amar decided to leave, and Amar was a genius, right? And so what happened, I didn't try and poach Amar, but on his last day, I said to Amar, look, man, I'm stuck. They haven't got a replacement. What are you doing? You got a job, or are you going contracting? He said, I'm going contracting. I said, have you got a contract? He said, no. I said, well, I'm about to post on an Upwork. Now, somehow the company got wind of this and they withheld his last 2 months' salary. And I remember he called me up and he's gutted. He's almost in tears, like saying, Pete, I think they found out they're holding my last 2 months' salary, and he's going to see a lawyer. And I said, look, go and see a lawyer, sort it out. I said, but my guess is it's just not worth it. I said, but what I'll do is if the lawyer says it's just not worth chasing it, I'll give you the 2 months' salary, right? Because you're stressed and you're no good to be stressed. And plus I can afford it and da, da, da. And I said, how much was it? And he said, $1,800. I said, $1,800 a month. And he's like, no, $1,800 for the 2 months. So this poor guy, it was a genius, and now works for us full time and gets way more money than that, right? They were paying this guy $900 a month, starvation salaries. And there's just so many people in India that want to escape poverty by doing IT, and it just became a problem. I don't like employing somebody who's starving, right? You know, and so basically we had some experience with some guys in Pakistan. I found a project manager. So what we decided to do, we said, let's forget India. You know, if you go to Pakistan at the moment, they're real nerds. So we've got an office in Pakistan. That's where all the development's going to happen. We've still got the other developers, but most of this year we've spent getting that team up to place. But what you're going to see right now with Jigsaw, you're going to see a big acceleration in development. We're currently looking for 6 more developers. So you're going to start to see a lot of really cool things coming out. We've been pretty slow, right, the past couple of years, but we've got the team in place now. So and we've got some great. Look, whatever we come out with, it'll be copied, right? I think we all know that by now. But yeah, put forward suggestions, man. But we're also gonna do some pretty wild stuff, and you know, it's gonna be fun. This next 12 months is gonna be fun. Pushing out the stuff that we're pushing out. So and I will put that into a blog post. I just wanted you to know, for those of you still here, that we do realise we've been a bit slow, right? We've now got a development manager that's got more experience than me. We've got a QA guy that's got OCD. I mean, he's just the best QA guy. I sent him a picture of me walking on a footpath by a canal, and he QA'd the footpath. It's like, you can't stop. So the quality is going to improve. We've got a couple of people in QA, hiring another, you know, we have a much bigger development team. Plus, we've got the kind of processes implemented now that we need as the team grows. So it's been a pain in the ass, and I've been quite invisible, right? I've not been on the scene much, but like sometimes you have to bite the bullet and stop moving forward to kind of move forward a bit later. But I really hope, I really think we're going to put some stuff out there that's going to give you some flexibility that you haven't had before, and you know, do some pretty cool things. I can't say what, because the pace we go, somebody will implement it before us. That's the only downside. But later on, all the stuff you want to do, just email me. We've got a team dedicated to the charts, so that's going to keep developing. We've got a separate team developing APIs. We've got a separate team developing the stuff that I can't tell you about. So there's not going to be this like, we're working on charts or we're working on the dome, right? We're going to be able to work on everything. So guys, what I want to say is I really hope you learned something about Trend and Chop today. And I really hope you enjoyed it. I do really enjoy these sessions where there's a lot of feedback. And Jay, honestly, I don't think I'm generous with the educational stuff, really. People help me. I'm not any more generous than the people who help me, which are some prop traders. You know, if we can help people put it together a little bit better. The only downside is I did get an email once from a guy, and he said, look, Pete, I really love all your educational material, and I followed everything you've been saying, and I can now say, because of this educational material, I'm now a profitable trader. And then he said, I'm not using your tools, but I want to thank you for the training. And if you remember, all of the training was online, and then we put it customer only. That email triggered that. So it's kind of a balance between paid stuff and then these sessions where we're trying to kind of fill in the gaps a little bit, you know. But you guys know I enjoy this, right? Yeah. Anyway, I enjoy it. So thanks, guys. I don't want to ramble too much at the end. If there's no questions, it looks like we're good. I'm looking for victims. It's really funny. I gave 3 potential trading problems that people had for me to resolve, and everybody replied they'd got all 3 of them. So I'm not sure what to do with that, but I will trawl through that. And as always, guys, thank you for listening. Good attendance, and I'll sort out the recording for you, because